So, what happens when a digital pioneer like a company processing nearly $2 trillion a year, touching almost 500 million active accounts, suddenly gets priced by the broader market like a sleepy, stagnant water utility?
Right. It's wild.
Yeah, today we are ripping open this really brilliant kind of under the radar valuation report from mid 2026. We're trying to find out if Wall Street has just completely lost its mind or if this towering digital empire is actually, well, starting to crumble.
It really is one of the most fascinating paradoxes in the market right now. I mean, you have the absolute bleeding edge of global e-commerce intersecting with this bargain basement, old school value pricing.
Yeah.
And it makes you wonder, which side of that equation is fundamentally broken.
Exactly. And that is the exact mission of today's deep dive. We've got our hands on a remarkably comprehensive forensic financial analysis of PayPal holdings. We're going to find out if the structural threats to their business model justify this severe dire rating, or if there's a generational buying opportunity just hiding in plain sight for you.
And just a quick note on the methodology of our source material today, because I think it really sets the
Oh,
stage.
for sure.
This report isn't some casual, back of the napkin overview. It actually uses automated Python and Bash scripting to track 39 critical valuation metrics over a 10-year period.
Which is incredibly thorough.
Right. It strips away all the narrative noise and visualizes the hard data in this very sleek Apple Kino black aesthetic. It's just a completely unvarnished look at the underlying cash flows.
It is a phenomenal foundation for us to work from. And before we tear into these numbers, if you want to run this kind of forensic analysis yourself, we have a quick note for you. To access more advanced researches, applications, and our latest Deep Values agents, welcome to explore and join Deep Values APP. To track total market temperature, welcome to search and download the iOS app Buffett Indicator from Apple App Store or Bubble Watch from Google Play.
And of course, the mandatory ground rules. Disclaimer. All analysis is based on publicly available sources and may be subject to revisions or differing interpretations. All contents from this channel is for research and entertainment purposes only and does not constitute any investment or financial advice or service. Conduct your own due diligence before making investment or financial decisions.
All right, let's get into the mechanics of this, because before we even look at the stock price or the valuation, I really want to understand the actual machinery.
Right.
Like, I know PayPal is ubiquitous, but sitting here in mid-2026, what does the engine of this company actually look like?
The sheer scale is, well, it's almost dizzying when you look at the raw numbers.
Yeah.
We are talking about 439 million active accounts.
Wow.
Yeah. And in 2025 alone, they processed 25.4 billion individual transactions.
That is just a staggering amount of volume.
It equates to a total payment volume of $1.79 trillion for that year.
Yeah.
But the key here is understanding how they monetize that ocean of volume, right?
Right.
88% of their revenue comes directly from transactions. Literally just taking a tiny fraction of a percent every single time money moves across their rails.
And the rest?
The remaining 12% comes from value-added services. So that includes things like, interest earned on customer balances, subscription fees, strategic partnerships, that sort of thing.
But the internal narrative has completely shifted recently, right? I mean, during the pandemic, it seemed like their only goal was user acquisition.
Oh, absolutely.
Just grab as many new accounts as humanly possible, regardless of whether those people actually, used the app. Has that strategy changed now?
Completely changed. The pivot is now entirely focused on profitable engagement. Management realized it doesn't really matter how many people have downloaded the app if it just sits dormant on their home screen.
Right, it's useless.
Exactly. The goal is frequency. And the data shows it's actually working. The average user is now transacting 60 times a year.
Okay, so that's roughly 5 times a month. So that frequency is basically the holy grail. It transitions the service from this deliberate choice you make at checkout into just an automatic subconscious habit.
Precisely.
But historically, their economic moat was just a two-sided network effect, right? Like, consumers use it because merchants accept it, and merchants accept it because a massive base of consumers want to pay with it.
That was the old moat, yeah. But network effects alone aren't really enough anymore, primarily because competitors like Apple and Google have built their own colossal networks.
Yeah, that makes sense.
So PayPal realized they needed something stickier. High switching costs are what truly protect a business from disruption today. You need to make leaving your ecosystem incredibly painful.
Which is where this new Fastlane product comes in.
Yeah.
Our source highlights this as a major catalyst. How does this actually work in practice?
So Fastlane is basically an accelerated guest checkout solution. Say you're shopping on a random merchant's website for the very first time. You really don't want to create an account. verify your email, type in your credit card.
Oh, I hate doing that.
We all do. With Fastlane, if the system recognizes your device or email, it securely autofills your payment and shipping details without even requiring a password.
Okay, let's unpack this. It's like an easy pass for the entire internet. It just waves you right through the toll booth.
That is a great way to look at the consumer experience. Internal research shows this speeds up the checkout process by 32 to 35%.
That's huge.
And in e-commerce, speed is everything.
Yeah.
Any friction at checkout equals an abandoned shopping cart. Fastlane is pushing conversion rates to over 80%.
Oh.
Yeah, which is up to a 50% improvement over a standard guest checkout.
But here is the kicker for the switching cost, just sticking with that Easy Pass analogy.
Good.
PayPal isn't just handing the customer an Easy Pass transponder.
Right.
They are installing the actual toll booth directly into the merchant's underlying software. If you're a merchant using BigCommerce or Salesforce Commerce Cloud, PayPal embeds Fastlane deeply into your backend. So if you ever get mad at PayPal and want to switch to a competitor, you basically have to rip up the highway. You are deliberately choosing to break your own checkout and lower your sales conversions. It totally locks them in.
That is the crucial mechanism right there. Network effects get people in the door, but embedding yourself into the foundational architecture of a merchant's business, that makes you mission critical.
So we have this incredibly sticky product. Engagement is up to 5 times a month, and the network is processing trillions. But this brings us to kind of a glaring contradiction in the report. If the engine is humming that beautifully, why is the company facing such fierce headwinds? Like, walk me through the Q2 2026 numbers, because something definitely seems off.
Yeah, on the surface, the top line looks incredibly healthy. I mean, they brought in $8.68 billion in revenue for the quarter, and total payment volume surged 10% year over year to over $486 billion.
But the market still punished the stock, so the bleeding has to be further down the income statement?
Exactly. Despite that really impressive revenue growth, their GAAP operating margins contracted by 171 basis points. They dropped down to 16.4%.
Okay, let's unpack 171 basis points for a second for you listening. That just means their profit margins shrank by roughly 1.7%.
Right.
Which honestly sounds like a tiny rounding error to a normal person. Why is Wall Street panicking over less than 2%?
Because at their astronomical scale, 1.7% represents hundreds of millions of dollars just leaking out of the bucket. They are processing significantly more money, but keeping much less of it as actual profit.
Wait, so are they essentially selling $1 for 95 cents just to keep market share?
Pretty much.
Because if I'm looking at this from a business owner's perspective, I have to ask, does winning the checkout war even matter if the margins keep shrinking to zero?
Well, what's fascinating here is the underlying cause of this margin compression. It really comes down to an evolving product mix. Historically, the company made its largest profits from the branded PayPal button. You know that highly visible yellow button you click on a website? That premium experience commands a premium price.
Because the consumer trusts the brand, obviously.
Exactly. But recently, their unbranded processing division, which is called Braintree, is growing significantly faster than the branded button. Braintree operates completely in the background.
Oh?
When you check out on a major corporate website and just type your credit card into a generic box, Braintree is often the plumbing routing that payment.
I see. So large enterprises prefer Braintree because they want to own the customer experience. They want their website to look pristine, so they just push PayPal behind the curtain.
Right.
But why does that destroy the profit margin?
Because when you become invisible plumbing, you operate in a highly commoditized space. You are competing entirely on price against very aggressive companies like Stripe or Adyen.
Oh, wow.
Yeah, if the merchant doesn't care about the PayPal brand, they'll just choose whoever processes the transaction for a fraction of a penny cheaper.
So they're successfully growing their total market share among these massive global corporations, but they're doing it with these lower margin white label products.
Yes, and the structural decline is pretty stark. A decade ago, their gross margin was in the mid 60% range.
Wow.
Today, it has steadily eroded to just under 39%.
That is a brutal drop. And they are facing outside macro threats too, right? Our source mentions Apple Pay and Google Pay, which are literally hardwired into the operating systems of the phones in our pockets. That feels like an unfair fight.
It is a formidable structural threat, without doubt. When the device manufacturer controls the hardware and the default wallet, it's incredibly difficult for a third-party app to compete for, top-of-mind awareness at the physical point of sale.
The report also brings up the potential elimination of de minimis tariffs on cross-border trade and the looming threat of open banking. Open banking being the idea that eventually infrastructure will allow consumers to basically pay by bank, directly, entirely bypassing credit cards and traditional payment networks.
Yeah, the permanent threats to their market share are very real.
Yeah.
The market looked at the shrinking margins, the commoditization of the unbranded business, and the rising competition from big tech, and investors just sprinted for the exits.
Yeah.
At one point, the stock experienced a 70% decline from its pandemic-era highs.
Which, I mean, that forces a profound reckoning. When your stock drops 70%, the board of directors can't just send out an optimistic PR memo. They have to fundamentally alter the DNA of the company.
Absolutely.
And this is where the story pivots from a tech narrative to kind of a Wall Street drama. In the summer of 2022, an activist value investor named Elliott Investment Management stepped into the arena.
And Elliott is infamous for their unsentimental, forensic approach to distressed companies.
Yeah.
They quietly acquired a staggering $2 billion stake in PayPal.
That's a massive position.
Huge. Analysts estimate their entry price was somewhere between $70 and $85 a share. And as soon as they took that position, they demanded sweeping operational discipline.
So they show up, slam their briefcase on the table, and force a comprehensive operational review. What actually changed internally?
First, they found $1.3 billion in annual cost savings. They reduced the labor footprint, they optimized global real estate, and slashed inefficient marketing spend.
Right.
But the most important shift wasn't just cutting expenses. It was a total paradigm shift in how they allocate capital.
Right, because for the previous decade, PayPal was kind of the ultimate Silicon Valley predator. They used their free cash flow to buy up every shiny new fintech company on the block.
Oh yeah, Venmo, Braintree, Honey, iZettle. It was all about aggressive acquisition-led growth.
But post-Elliott, the M&A department effectively shut down. They stopped buying other companies. Here's where it gets really interesting. Instead, they started aggressively buying themselves.
The share repurchases.
Yes.
Management authorized a $15 billion share repurchase program. By mid-2026, they're dedicating 75–80% of their entire free cash flow purely to buying back their own stock and retiring those shares permanently.
That is wild.
They returned $6 billion to shareholders over the trailing 12 months ending in mid-2026.
It's like realizing you don't need to keep building expensive additions to your house. Sometimes you just need to fix the plumbing in the house you already own to make it valuable.
That's a great analogy.
You have this former hypergrowth tech disruptor suddenly acting like a mature, boring value stock.
And they made some incredibly shrewd strategic moves to fund this new strategy. For instance, the KKR deal.
Oh, right.
PayPal had billions of dollars tied up in European buy now, pay later loans. Holding those consumer loans on your own balance sheet requires immense capital reserves.
Yeah, and it exposes you to major credit risk if the economy turns and those consumers default.
Exactly. So they called up KKR, the massive private equity firm, and struck a deal to sell off 40 billion euros worth of those European loan receivables.
And that move instantly generated $1.8 billion in hard cash for PayPal.
Yes, it did.
Wait, hold on. Let me push back on this for a second. They sold off an enormous portfolio of loans just to generate cash. And what did they do with it? They funneled an additional $1 billion of it directly back into buying their own stock. Isn't that just financial engineering? Like, are they just manipulating the share price rather than actually investing in growing the underlying business?
It's a totally fair question, and critics often point to that. But you have to look at the mechanics of capital efficiency here. By selling those loans, PayPal shifted to an asset-light model.
Okay.
They offloaded the credit risk entirely to KKR. If there's a recession in Europe, KKR takes the hit, not PayPal. Meanwhile, PayPal takes that cash and buys back their own stock while it's trading at historically depressed multiples.
Oh, I see.
Mathematically, buying back undervalued stock delivers a much higher return on investment than holding risky, low-yield consumer loans.
So it isn't just a gimmick to prop up the stock price. It's fundamentally de-risking the balance sheet while shrinking the pool of outstanding shares, which means every remaining shareholder owns a slightly larger slice of the overall profit pie.
Exactly. And to ensure this disciplined philosophy sticks long-term, they completely overhaul the leadership structure. The old founder-led era is officially over. No Peter Thiel, no Elon Musk, no Max Levchin. The new CEO is Alex Chriss, and his mandate is uncompromising.
His compensation package really caught my eye in the report. His payout and the compensation for his top executives for the 2024 to 2027 period is strictly tied to relative total shareholder return compared to the S&P 500.
And that structural alignment is just music to the ears of deep value investors. When executives earn exponentially more from sustained, profitable business growth and stock performance than from their base salaries, they don't waste money on vanity projects.
Okay, so the narrative has undeniably transformed. We have a disciplined management team, an uncompromising buyback machine, and rigorous cost-cutting. But let's get into the actual strict Graham and Dodd style math.
Let's do it.
What does the valuation tell us about the stock price today?
Well, if we connect this to the bigger picture and look at the trailing 12-month metrics ending in mid-2026, the valuation discipline is striking. The trailing price-to-earnings, or PE ratio, is sitting at a multi-year low of 10.42x.
Just to put that into perspective for you listening, during their hyper-growth phase just a few years ago, this company historically commanded earnings multiples between 40x and 60x.
Exactly.
Wall Street treated them like a limitless growth engine. Now it is at 10. That implies the market has aggressively derated them into, like, utility company territory.
The PEG ratio is also very telling. It sits at an attractive 0.83.
Let's define the PEG ratio real quick. That's price earnings to growth, right? How should we interpret a 0.83?
All right, so the PEG ratio assesses a company's valuation while factoring in its expected earnings growth. A PEG ratio of 1.0 basically means the stock is fairly valued given its growth rate.
Okay.
Anything below 1.0 generally indicates that the company is undervalued. So the forward growth expectations easily justify the current depressed earnings multiple.
And let's not forget the cash generation, because without cash, you obviously can't fund those massive buybacks. Over the trailing 12 months, their free cash flow was $5.5 billion, translating to a 16.3% margin relative to revenue. Return on equity is a stellar 25.15%.
Which really proves a vital point. Despite the gross margin compression we discussed earlier in the unbranded business, the firm still generates immense cash returns on the capital they actually deploy.
Right.
They require very little physical asset replenishment to sustain operations. For instance, depreciation only consumes 6.9% of their gross profit.
Our source also highlights a fascinating piece of accounting housekeeping. The report mentions the adoption of a new SEC rule, Staff Accounting Bulletin number 122. Can you translate that out of accountant speak for us?
Absolutely. So when PayPal allows users to buy and hold cryptocurrencies on their platform, older accounting rules required them to record those digital assets as massive liabilities on their own balance sheet.
Which makes them look terrible.
Right. It made their books look artificially bloated and risky. SAB 122 allowed them to cleanly remove $2.88 billion in crypto asset safeguarding liabilities from the balance sheet.
So they essentially wiped $2.8 billion of paper risk off their books overnight.
Yes, and it dramatically streamlined their financial architecture without impacting their income statement or actual cash flows in any way. It's just a great example of the new management team optimizing the details.
But the ultimate test of intrinsic value in this report is the discounted cash flow, or DCF, analysis. The analysts modeled out 3 specific scenarios to find what the business is truly worth today. And they applied a strict 10% discount rate, demanding a 30% margin of safety on the final purchase price.
The margin of safety is a core tenet of value investing. Think of it like building a bridge. If your calculations say the bridge needs to hold 10,000 pounds of traffic, you build it to hold 15,000 pounds.
Just in case your math was wrong or an unexpected storm hit?
Exactly. That is what this report did with PayPal's valuation. They calculated the value and then demanded a 30% discount on that price just to be totally safe.
Let's walk through these 3 bridge building scenarios. The first is the no growth case. This assumes the company has reached permanent total stagnation.
Right.
Free cash flow stays completely flat at $5.50 billion forever. They never grow again. Under that absolute worst-case scenario, the intrinsic value with that 30% margin of safety applied is $43.16 a share.
That serves as your foundational floor. It tells you the absolute bare minimum that cash flows are worth. Next is the conservative case. This assumes a mere 1% annual growth of the next 5 years, followed by a 2% terminal growth rate.
A 2% terminal rate essentially means they just match long-term macroeconomic inflation, right? They are just treading water in the broader economy.
Correct. And in this incredibly modest scenario, with the 30% margin of safety applied, the target buy price is $55.01.
And finally, the nominal case. This relies on their actual 10-year historical average growth rate. It projects 11.8% growth for the next 5 years, eventually stepping down to a 3% terminal rate. If they achieve that historical norm, the target buy price, again with the 30% buffer built in, is $88.35.
Now, connect those intrinsic values to the actual reality of the market. As of mid-2026, the stock is trading at $56.07.
So what does this all mean? It means the market is essentially betting that PayPal's best days are so far behind them that they will barely outpace standard economic inflation for the rest of their corporate life. They are pricing it almost exactly at the conservative case.
The math presents a profound, asymmetric risk-to-reward ratio here. If the management team executes on the Fastlane rollout, maintains their operational cost efficiencies, and continues retiring shares,
Yeah.
the actual intrinsic value of the business shoots comfortably past $120 a share undiscounted.
Wow.
The upside is substantial.
But even if they stumble along, face brutal competition from Apple and only manage 1% growth, your downside is largely protected by that immense wall of $5.5 billion in free cash flow. You are buying the conservative case right now.
It is a real-world masterclass in how market sentiment can detach wildly from underlying math. People see the gross margin compression in the unbranded business, they read headlines about Apple Pay, and they just panic.
Yeah.
They completely ignore the fact that the company's a cash-generating juggernaut. It also highlights how activist investors like Elliott Management can force a hyper-growth tech darling to mature into a disciplined, shareholder-friendly value stock overnight.
It really has been a remarkable corporate journey to unpack today. We've watched a company evolve from aggressively trying to conquer the world by buying up every new fintech app, to dealing with the severe reality check of shrinking margins, to finally settling into this incredibly disciplined rhythm.
Right.
They are ruthlessly optimizing the empire they already own, buying back their own stock at a PE of 10.
They essentially traded the illusion of limitless, unprofitable expansion for the reality of highly profitable, predictable cash generation.
It really makes you reconsider what makes a company valuable in the long run. But as we wrap up today's deep dive, there is one final provocative thought I want you to mull over. The entire payments industry is clearly moving toward completely frictionless, invisible transactions. We spent time talking about fast-lane autofilling credentials to speed up checkout. If digital payments eventually just become background code silently built into our phone's operating system and our web browsers, who actually owns the customer relationship in the future?
Oh, that is the ultimate existential question for the entire fintech industry.
Is it the traditional bank that holds your deposits? Is it the device maker that controls the glowing screen in your hand? Or is it the invisible payment network operating in the dark plumbing of the internet? It's something to seriously think about the next time you casually tap your phone to pay for a coffee. It might look as clean and predictable as a utility company on the surface, but underneath, the battle for the future of commerce is anything but stagnant.